Earlier this month, I asked you to suggest some stocks over our YouTube community and over on Patreon, and let's just say that you delivered. So let's go over the 8 most suggested stocks, starting off with Nvidia, which is of course in the semiconductor industry. You can define it as a pioneer of GPU accelerated computing for the gaming, data center, and automotive sectors. This company has one of the greatest return on capital employed I have seen with a 92%, and what this means is that they're extremely good at obtaining profitability from every dollar that they invest. And this can be clearly seen if we just look at the income statement. Look at that revenue, gross profit, and net income growth. It's extremely sustainable, it's explosive, but the most important fact, margins are not decreasing. In Q3 of 2024, they had net margins of 55%. And as if this wasn't enough, when we look at their balance sheet, you can see that their total assets have been expanding quite rapidly, but their total liabilities have stayed pretty stagnant. Of course, they have been increasing, but currently they have over 3 times their total liabilities only in their total assets. And what's greatest about this stock is that if we compare their historic PE ratio and their price to cash flow ratio, this stock looks like it's actually trading right around their average for the past 5 quarters. However, when we look at their free cash flow yield, they're currently yielding a 1.7%, which when comparing it to the 3% long-term inflation rate can suggest that this company may be at an overvalued price. But hey, I will give this stock 5 stars due to its high quality growth, its high margin sustainability, but the only thing that is kind of dragging on this stock is the fact that it has a very high valuation, but also adding to the fact that Wall Street's expectations on Nvidia are so high that if at any moment the stock does not deliver on any of its earnings, the whole market, and especially Nvidia stock, will probably go down. Next on the list is Mercado Libre, ticker symbol Melly. And this is a company which operates online marketplaces which are dedicated to e-commerce and other online auctions. I'm sure you already know this company, but if you don't, you can think of this as the Amazon and eBay combined of Latin America. And they also know exactly where to place their capital, as they have a 25% return on capital employed. We can see that this company has had explosive revenue growth, which is amazing to see, and it looks like it has not missed a single quarter. Adding to this, we can see that yes, their total assets have increased, but they're still maintaining a steady current ratio by increasing their total liabilities at a slower pace. And now in a similar fashion to Nvidia, Melly looks like it's trading at around its average for the past 8 quarters for both its price to cash flow ratio and its price to earnings ratio. However, due to its growth, this company's PE ratio is not cheap. However, when we look at it from a free cash flow yield, it's currently yielding a 6.8%, which is a lot higher than the 3% long-term inflation, and this may suggest that the company is attractively valued. Now I give this company 4 stars. I believe this company is amazing and I would be very inclined to purchase this asset, as it is a high growth market leader with a very high return on capital employed and a very solid balance sheet. However, its low net margins are keeping me on the sidelines as I track how they are able to increase and expand those margins. Stock number 3 is Sofi Technologies. Now this is a personal finance and financial technology company which operates basically as a direct bank, but everything is done online. They basically have a financial super app which helps customers save, earn, spend, whatever you can think of that involves money. And this company recently actually turned profitable, as we can see in Q4 2023. And one thing that Sofi has is that it's a very fast grower. Their revenue has increased substantially from Q1 2023 all the way up to Q3 2024. However, it has faced some periods of slower growth. As we can see in Q2 2024, the revenue was smaller than the previous 2 quarters. But that's okay, every company has its small bumps on the road. This company additionally also has a very solid current ratio, with total assets being way above its total liabilities for all quarters for the past 2 years. And over here, when trying to compare the historic PE ratio for the past 8 quarters, this is actually not shown to us by TradingView, because in the previous quarters they still had a 12 trailing month negative earnings, which actually causes there to not be a price to earnings ratio. However, we can still assess their valuation when considering their price to cash flow ratio. And having said that, this company is actually trading at a pretty hefty valuation currently, as it's trading at around twice more or less the average price to cash flow ratio of the past 2 years. Now, when looking at the return on capital employed and their free cash flow yield, we still haven't been able to calculate that, because for the past 12 months they actually have yielded negative free cash flow, which means that these two values cannot be calculated. Now, given this, I have given Sofi a 3-star rating, and I was doubting between 3 or 4 star. but I think that ticker symbol Melly is a better purchase than Sofi. So I had to move this company down. And I believe that this is a high growth company, but I don't like the fact that it's diluting shareholders at a high rate and that it has low profitability. Now moving on to Uber Technologies. I'm aware that everyone knows this company, but just in case you don't, this is a company that offers ride-hailing, food delivery, package delivery, and even freight services among all their other offerings. Now you have probably seen my latest video on Uber, and at the end I actually ended up purchasing this stock. However, I'm still going to include it here as it was requested, but the fact is that we have over here a very solid company, with a return on capital employed around 15%, which is right where our threshold usually is, and this has been increasing quarter after quarter. Then their income statement, they have been growing revenues around 14-15% year over year, and they're truly now showing the world how profitable they can actually become, and they have so many initiatives going around just cutting costs and focusing on improving those margins, which is something that I love to see and something that in my investments has played out amazingly well. Now their balance sheet is getting better by the quarter, as they're getting every time a lot more assets, while their liabilities are actually growing at a slower pace. And now finally, when we look at their valuation, we can see that both their price to earnings ratio and their price to cash flow ratio have actually been trading at the lowest they have been trading for the past 2 years. And this was recently due to the rumors or concerns about robo-taxis actually taking over Uber. I have discussed this in my previous video, and I think that this is overblown, which is why I actually ended up starting a position. We can see that Uber has a 4.3% free cash flow yield, which when comparing to the 3% long-term inflation, deems it as that it may be at an attractive valuation. Now I give this company a 5-star, it is a growth company with quickly expanding margins, and it is trading at a low valuation. Now ticker symbol LPG, full name Dorian LPG. It's a liquefied petroleum gas shipping company, so basically it works in the energy industry, and this company in particular has a very high 26% return on capital employed. However, we can start to see the red flags when analyzing this company, as its revenue has been contracting every single quarter since last year, and their margins have been decreasing at a super fast pace. Just look at the fact that they barely made profits in quarter 2 2024. Now their balance sheet has stayed pretty stable, but this would basically mean that their return on capital employed and other efficiency ratios have gone down. Regardless, they have a current ratio that's okay with almost twice their assets than total liabilities. And when we look at their valuation, it looks like this company is trading at very low multiples, and I'm guessing that this is why this stock was recommended, but I will give this company a 1-star, has decreasing revenues in a commoditized industry. So unless you're highly knowledgeable about the sector, which I'm not, I would stay away from this company. Next is Honda Motor Company, ticker symbol HMC, and this company manufactures and sells automobiles, motorcycles, and power products. This company has a return on capital employed of 7%, with a free cash flow of 0.1%, meaning that they barely made positive cash flow this year. Now, when we look at their income statement, it has been very stable, with their margins actually thinning out quarter after quarter, and their balance sheet is looking okay with them having around twice their total assets and their total liabilities. But this is where it gets interesting. This company has historically traded at a very low valuation because of their low growth. However, in the recent quarters, their price to cash flow ratio has shot up because of 2 different factors. Firstly, their cash flow generation has decreased substantially, but secondly, this company has a lot of rumors surrounding an acquisition or a merger with Nissan. And this has driven up a little bit the stock price, but I don't think it's enough to actually buy the company, and I will give it 2 stars because of the razor thin margins and stable revenues. But as I said, I believe it's highly dependent on M&A news, and if they don't go through, well, the stock price may suffer. Next we have ticker symbol Cabo, which stands for Cable One, and this company engages in the provision of data, video, and voice services to both residential and business consumers, so it basically engages in cable television. Now, due to the adoption of the streaming platforms, of course, this company is losing revenues, and as we can see, quarter over quarter, they're slowly decreasing. Now, they're managing to more or less keep stable margins, which is okay, and they're actually being profitable. When we look at their balance sheet, they have a lot more total assets than total liabilities, maintaining an okay current ratio. And when we look at their historic price to earnings ratio, it seems like they're currently trading at below what they have been trading for the past 2 years. And I'm not entirely sure why this company was trading at such a high valuation in the first 3 quarters of 2023, but it looks like it may have been from a very negative earning quarter in quarter 4 2022, as its price to cash flow ratio wasn't actually heavily affected. Now this company has a 15.6% free cash flow yield, which when compared to the 3% long-term inflation rate, makes it look like it's very undervalued. However, I still give this company a 2-star, as its decreasing revenues and profitability with a low return on capital employed makes it hard to think that this company will be around for the following 10 years. And now last but not least, we have Novo Nordisk. I believe it's Europe's largest company. It is mainly famous for its treatment in the diabetes and the obesity care segment, and this company has a return on capital employed of 26.2%, which is extremely solid. This company has been growing at a very fast pace, sustaining very wide margins, which is incredible to see and makes this a very nice company to look at and even consider to own. We can see that their total assets have been increasing over the past 3 quarters at a pretty aggressive pace, and this is not entirely great because what it does is that it reduces your efficiency ratios. However, since they have been maintaining their current ratio and their total liabilities have expanded at a slower pace, this should not raise too many alarms. And when we look at their historic valuation, we can see that they're currently trading more or less at the average that they have been trading for the past 2 years, right around a 39 PE ratio and around a 29 price to cash flow ratio. However, I do know that this company has experienced a very sharp decline in price, so this may open up opportunities. Now they're currently yielding a 3% free cash flow yield, which means that it may be right around fair value. But I still give this company a 5-star rating because it has fast revenue growth with solid margins and it's supposed to be trading at an attractive valuation. However, you do have to remember that these pharmaceuticals or healthcare companies always carry regulatory risk. I'll be doing one of these every month, so pay attention to the community or even join the Patreon if you want to suggest stocks for future videos. And I'll thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content and I'll see you in the next one.